In this video, you'll find out what equity means in accounting. I'm going to give you 2 definitions. Yes, 2. Then we're going to break it down to see what it's made of and take all of the pieces and fit them back together to get a complete picture of what equity is and how it fits into the expanded accounting equation. Hey viewers, I'm James and welcome to Accounting Stuff, the channel that teaches you all you need to know about accounting and bookkeeping. If you'd like to learn more about these topics, then check out my Accounting Basics playlist up here. I think we're almost up to 20 videos now and I keep adding to it each week, so subscribe and hit the bell to be notified when the next video is out. Over the past couple of weeks, we've talked about assets and liabilities, which leads us nicely into today's topic, equity, the third and final pillar of the accounting equation, which looks like this. Assets are equal to liabilities plus equity. I've had plenty of requests for this topic and I totally get why. Equity is the oddball in the accounting equation and there are so many different terms and jargon that come with it as part of the parcel. Wow, so many, and this isn't even all of them, but I've cherry-picked these ones to teach you today because if you can understand these, then you'll have a solid grasp of what equity means, and to be honest, you'll be far ahead of most of the other people out there who are still battling with this topic. Oh, and by the way, if my voice sounds funny today, it's because I've been struck down by the man flu. We've had a chilly week in Vancouver and it's finally got to me. But anyways, are you ready? Let's do this. At the start of this video, I promised you 2 definitions of equity in accounting, and here's the first. Equity is the residual value of an entity's assets after deducting all its liabilities. That's it? Hold on, I'll explain how this works. First, let's bring up the accounting equation again. You'll be seeing this quite often in this video, and it'll become clear why later on. Assets are equal to liabilities plus equity. If we rearrange this formula, then we can see that equity is made up of assets minus liabilities. Now we accountants have another word to describe assets minus liabilities. Net assets. I said a moment ago that equity is the residual value of an entity's assets after deducting all its liabilities. Residual value basically means what's left over after you take all of an entity's assets and deduct its liabilities. In other words, what we've got here. Equity represents the net assets of a business. Simple, hey? Yes, it looks simple, but what does it actually mean? Definition number 2 is going to help us shed some light on this. It says that equity represents the net funds invested into a business by its owners. I like this description of equity because it gives us some context. Let me explain with the help of the accounting equation. On the broadest scale, there are 2 ways that funds can be invested into a business to finance its operations, and you're currently looking at both of them. It could choose to borrow money from third-party lenders like banks, which in essence are liabilities, or it could choose to use the net funds invested into the business by its owners. In other words, it could choose equity. So now we know that equity represents the net assets of a business, and at the same time, it represents the net funds invested into the business by its owners. So what we're saying here is that the owners of a business own or have a claim on all of its net assets, and we call this equity. Make sense? Now that we've got an idea of what equity means, let's have a look and see what it's actually made of. Full disclosure here, equity is made up of a lot of things, and some parts are a bit complicated. But I mentioned at the start that I've cherry-picked the parts that I think are most important, that will give you the most value. 3 in particular that together will give you a solid understanding of what equity is, and I'll share them with you in a moment. But first, I think it'll be easier for you to picture all of this if we work with an example. Imagine that you've got an idea for a business. You've been following the plastic-free Feb movement on the internet and you've come across this video.
90% of all...
Gross. You realize that plastic makes up 90% of all ocean debris. So you come up with an idea to decrease the number of plastic bags by developing your own reusable shopping bag to help save the planet. But there's a problem. You have a choice to make that all startup businesses end up facing. How to structure your business. You could choose to go it alone, become a sole proprietor and avoid incorporating the business as a separate legal entity. You could go in 50-50 with a mate and form a partnership, or you could decide to create your own corporation, a separate legal entity that's owned by its shareholders. Now, there are pros and cons to each of these, but that's for another day. Let me know down in the comments if you'd like to hear more about it. I want us to rewind for a second. I said that equity is essentially made up of three things. And the reason why I've laid all this out here is because the words we use to describe these three things changes depending on the structure of the entity. And I think that's partly what makes equity seem so complicated. There is so much different jargon that we use to describe what is essentially the same thing. Let me show you. The first thing that makes up equity is capital contributions. Capital relates to the funds raised to support a business, and contributions simply mean that these are given to the business. So capital contributions is the money that the owners invest into the business out of their own pockets. Now, the way that we describe this changes depending on who the owners are. And that changes based on the structure of the business. If you're a sole proprietor, then there's only one owner, you. So you'd call the money that came out of your own pocket owner's equity. However, if you were part of a partnership, then the owners of the business would be the partners, so you'd call the capital contributions partner contributions. And if you created a separate legal entity, a corporation, then the owners of the business would be the shareholders, and you'd call the funds invested shareholders' equity. So we have three different terms that describe basically the same thing. Capital contributions are one of the ways that businesses tend to fund themselves during the early startup phase, before they become profitable. Imagine that you choose to become a sole proprietor, at least at first, and you invest $1,000 of your own money into your reusable bag business. What's your business's financial position? Let's bring up the accounting equation again. Your business has assets of $1,000 in the form of cash, and you, the owner, have a claim of $1,000 on those assets, which we call owner's equity. The accounting equation is in balance, as it should be, because when we're looking at a snapshot of a business's assets, liabilities, and equity at a single point in time, we're looking at its balance sheet. Now, capital contributions aren't the only thing making up equity. When your business generates revenues or incurs expenses, it'll make a profit or a loss, which is just revenues less expenses. What happens to that profit, and who does it belong to? You, of course. You're the owner, so you could choose to reinvest these profits back into the business or hold on to them to use in the future. Over time, these profits and losses that you're holding on to build up, and we call them retained earnings. Retained earnings are defined as accumulated profits held for future use. And thankfully, this term stays the same regardless of whether you're a sole proprietor, a partnership, or a corporation. Your business's equity is made up of two things: capital contributions and retained earnings. Over time, your reusable bag business starts to make some real money. So much, in fact, that you no longer need to dip into your own pocket to fund it using capital contributions. You can cover all of the expenses using the accumulated profits that you've held onto and set aside, your retained earnings. Within a year, your business is booming. You've got much more money coming in than what's going out. In other words, you've got a net cash inflow. But back home, all is not so rosy. You've invested so much of your own savings into the business through capital contributions that you're running out of money to live on for yourself. You need to withdraw some cash out of the business to cover your own personal expenses. Well, how does that work? Retained earnings are made up of a couple of things. Remember I said that they're your accumulated profits held for future use. So a big chunk of your retained earnings is your accumulated profits, which are your revenues less your expenses, which come straight from your income statement. An income statement is a financial report that you use to track your revenues and expenses over a period of time. But retained earnings are also made up of withdrawals, the money that's taken out of the business and distributed to its owners. We have different terms to describe withdrawals depending on the structure of your business. For sole proprietors, we call them drawings, and for partnerships, we call them partner drawings. And for corporations, we call them dividends, which are profits distributed to the shareholders. Again, we have three terms all used to describe what is essentially the same thing: withdrawals. As the sole proprietor of your reusable bag business, you can use drawings to withdraw your accumulated profits for personal use. This impacts the accounting equation by decreasing assets because the business's cash has gone down, and decreasing equity because your claim on those net assets has decreased. Hold on, now I want to show you something interesting. We've broken equity down into capital contributions, retained earnings, and withdrawals. But let's see how this all fits together using the accounting equation. Earlier, I said that when we look at a snapshot of the accounting equation at a single point in time, we're looking at a balance sheet. The balance sheet is made up of three things: assets, liabilities, and equity. And we know that equity is made up of capital contributions from the business's owners and retained earnings, which are its accumulated profits held for future use. Retained earnings break down further still into accumulated profits less withdrawals. And accumulated profits are a business's revenues less expenses, which when looked at over a period of time make up its income statement. So what we've got here is the expanded accounting equation. And I like this because we can see how two of a business's major financial statements, the income statement and the balance sheet, are linked together through equity. Thanks for watching. If you found this video useful, give it a like, share it, comment, subscribe if you haven't already. Do you remember that guy from the video I showed you earlier? Well, that's actually my brother, Will. He created the campaign for plastic-free Feb, so if you'd like to learn more about that and how to get involved, then join the Facebook group and follow their Instagram. I'll drop the links to these down in the description below. It's a great cause, and it would be awesome to have you involved for next time. And you don't even have to wait till February. You can follow some of their recommendations and start cutting back on some of that plastic now. As always, let me know down in the comments if you've got any questions, or message me directly on Instagram @accountingstuff. See you next time.